Section 2, we're going to talk about the cost and methods of obtaining credit. So you kind of learned what is consumer credit, what is credit, the two different types, open and close-ended. The main common type is your credit cards, but also loans. All right. But now the cost and methods of obtaining credit, we're going to dive into. First, you need to ask yourself, well, can you afford a loan? Okay. And a loan is where you borrow money and you must repay. And it usually, as we said before, the cost of credit or the cost to borrow money is interest. All right. You got to ask, will you be able to make the payments? And you want to consider three things. Cash flow, that's your income and expenses. So what you want to do is add up all your monthly expenses, subtract your take-home pay, and what the amount of money you have left over. If you are not able to make a monthly loan payment and still have money left over after that, you shouldn't get a loan. Okay. You also want to consider trade-offs. So because you get a loan, whether it's a credit card, mortgage, or car loan, are you okay with cutting back on some fun activities like going to the mall, shopping, going to the movies, etc.? Are you okay with saving less because you got to make your payments? So trade-offs that you have to consider. And lastly, what's called your DPR, your debt payments to income ratio. That is just the percentage of debt you have in relation to your income. Should be less than 20%. And we're going to dive more into this in the next slide in class, along with what I want to dive a little bit deeper in with section 1. So we're going to go ahead and skip this and move on to the cost of credit. Now, this is interest. The cost to borrow money is interest. You want to look at the finance charge. All right, that's the interest. Just another word for interest is finance charge. That's the total dollar amount you pay to use credit. All right, so if I have let's just say a $50,000 college loan and the lender charged me 12% interest rate, let's just throwing out numbers, that 12% interest, that's my cost of credit. That's my finance charge. This is calculated by using APR, what's called the annual percentage rate. It's the cost of credit on a yearly basis. All right. You really just want to look at and compare when you're looking for a credit card or for loans, the different interest rates. You want to try to find the lowest interest rate. So for example, when we talk about interest rate, if your interest rate is 18%, that means you're paying $18 on every $100 that you spend. All right. So the biggest thing with credit, no, there's a cost to it. That is the interest. And to look and compare interest rates, and we'll be doing that in class. With loans, and well, really with any type of credit, you want to look at the term versus the interest rate. Term is the period of time for a loan. Okay. You want to compare that to the interest rate. If you have a loan that's a longer term, you usually pay lower payments. So, for example, my college loan is a 25-year loan, a closed-end credit. Okay. Since it's a very long term, I pay lower payments every month. But because it's a longer term loan, I get charged more interest. So that's why the advice I want to give you is whenever you have a loan, any type of credit, you want to pay more than a minimum balance to shorten that term. Because if you look at the two examples of creditor A, creditor B, you can see the interest rate, the APR, is the same, but the term of the loan is just a 1-year difference. But just look at, you can see our monthly payments are cheaper for creditor B, which has a longer term loan. But look how much extra they're paying in interest, which is the total finance charge. They're paying about $400 more in interest just because their term of their loan is one longer year. Okay. So you really want to have shorter terms and pay more than the minimum. That's what I'm doing now with my college loans, so I could pay it off in less than that 25 years and hopefully relatively soon for myself. So you want to balance the term and the interest rate. Continuing with cost of credit, you want to avoid the minimum monthly payment trap. And that's the minimum amount you have to pay per month. It's not the full amount, okay? And remember, whenever you have a balance, carrying over, you're paying interest on that. Okay. So you want to avoid just paying the minimum monthly payments. Okay. You want to always pay more than that. Ideally, you want to pay your whole balance in full. And hopefully I get you to think like that when you take out credit when you're a little bit older. Because by just paying the minimums, it takes you longer to pay back, and the lender makes more money off of your interest. Okay, because it's taking you longer, as we just said before, it's taking you longer to pay it off, which means interest is accumulating more and more and more and more. You're paying more in interest, and the lender is making more money in interest. So avoid that minimum monthly payment trap. The 5 C's of credit. Okay, when a lender is considering you for credit, they look at the 5 C's. Okay. First C is character. Will you repay? Are you trustworthy? Second, they look at capacity. Can you repay? They look at your income here. Can you actually repay the loan? Thirdly, they look at capital. That's your net worth. Remember, our assets minus your liabilities. All right. That's saying if you were to lose your income, can they take some of your assets away so you can still repay your loan? Collateral. All right. This is looking at property that can be taken. If you start failing to repay, the lenders will start just taking your property. So they look at what collateral do you have just in case you stop paying. And lastly, your credit history. That's your borrower reputation. It's based on a credit score. And I have a graphic to show you in class that shows us what's a good, bad, and average credit score. All right. So these are the 5 C's lenders look at when deciding to give you a loan. Just because you ask for a loan doesn't automatically mean you're going to get it. All right. They look at the 5 C's and they come up with a yes or no and allowing you to have a loan. With your credit report, okay, that lenders pull up, there are 3 legit credit bureaus, okay, Experian, TransUnion, and Equifax, all right, that you can find out your accurate and official credit score, all right. You see freecreditreport.com, those aren't legit credit bureaus because they use a different unofficial formula in generating your credit score. All right. And the 3 legit credit bureaus, they obtain information on you from banks, finance companies, stores, credit card companies, and other lenders. So note the 3 main credit bureaus that you can obtain your credit report from and your official score: Experian, TransUnion, and Equifax. All others use different formulas. They are not the legit official credit bureaus. So just make note. And what they have on file when they pull up your credit report contains your name, your social security, your birth date, your employer, how much you make, any previous employers, if you're married, your spouse's information. So they have all these types of information on you, all your credit information from all your credit cards and loans, any bounced checks. So just note that these credit bureaus have a lot of information on every single one of us, and you just want to make sure that your credit score is in great standing. And hopefully from what we are going to learn in Chapter 6 and what you have learned from watching these videos, we're going to get there. All right. The biggest thing with this chapter is making sure we don't fall in the monthly minimum payments trap. We pay more than the minimums. Okay. And when we are filing for credit, and you will need credit to get a house and get a car, the banks are going and lenders are going to want some history on you. So we're all going to need credit. You're going to have to use a credit card and take out a loan at one point in your life. You want to compare and try to find the lowest interest rate to help yourself out.